What is going on, investors? Hopefully you guys are having a great day out there. On today's show, we are going to be talking about TDOC Health, which is down 46% over the last year. We're going to take a look at PLTR Technologies as well, which has basically been flat, down about 2% over the last year. And the other big decliner in Cathie Wood's portfolio has been Zoom Video. This stock is down over 51% during the last year, including an incredible drop after reporting earnings this week. Take a look at each of these three stocks and see if any of them are lining up to a buy the dip opportunity. We know Cathie Wood has been getting in here and buying these stocks religiously over the last year. And as you can see, that's been a terrible strategy because these stocks continue to pull back, especially when we're talking about TDOC and Zoom Video. These stocks are in very well-defined downtrends. And in fact, they've accelerated over the last few weeks. And then we'll look at PLTR, which really has just gone sideways for the last year, which is not necessarily a bad thing. For a growing company to grow into a valuation, you can do that going sideways. And we've seen Amazon, we've seen Tesla, we've seen Apple, we've seen a lot of great stocks go sideways for more than a year and then all of a sudden break out. So in PLTR's case, we're talking about the area where this one might break out and show that, hey, we're out of this sideways consolidation. The buyers and sellers have kind of equalized. Buyers have taken over. This one's zooming up to the top. Now, speaking of zoom, we're looking for a bottoming formation in this stock, which is just completely broken apart. And it almost looks identical to what's going on over at TDOC. We'll talk about, are we pulling into areas where you can now buy the dip? And believe me, if you've gotten at this at a higher price, you are probably like 90% of the people out there. Look at the volume at lower prices on this stock. Nobody bought it back here. Okay. And so if you're in these stocks at a higher price, don't feel bad. You're pretty much like everybody else. Okay. And so we'll talk about some of the strategies for next time. Okay. Everybody has made mistakes investing in the stock market, myself included. That is how you learn. In fact, I look forward to making mistakes because they are painful, because in the case of the stock market, it often is financial as well. So you're losing money and you made a mistake. It's a great learning experience. So I'll talk to you through some things where you can be a little bit more patient in terms of buying the dip on these stocks. Now, you had to be patient with TDOC Health. This stock was up over $300 per share, and now we're trading just over $100 per share. Wow, that is an incredible drop. Now, what's also dropped along with it is this market cap. Think about this. This market cap was basically 3 times higher than this. So we're talking about a company worth well north of like $50 billion. That made absolutely no sense when I show you these financials in a second. But now we are talking about a company worth just, and I say just, it's the smallest of the companies that we're looking at here. And when you look at a lot of mega cap tech that are hundreds of billions, maybe even $2 trillion, well, $17.5 billion valuation doesn't necessarily seem that rich. And I'll show you here why it doesn't necessarily seem that rich. We'll get to the earnings and the stuff that's going on at TDOC, but what I want to show you is, so they've come out with some revenue estimates, and I might as well go over this. So TDOC came out with an investor day. This was just a couple of days ago, and they said for their full year revenue this year, they're looking to do about basically $2 billion. For the upcoming year, 2022, they're looking to do about $2.6 billion. So let's look at this from a price to sales perspective, okay? Let's give them credit for $2.6 billion worth of sales next year. That's just 6.5 times sales on this one, okay? Not as wildly overvalued as it was just a couple of months ago. So that's why when these stocks that have a lot of momentum behind them have a super high valuation, I like to just wait. If I'm wrong about it, okay, I can get in at a later date. Maybe I was proven wrong. A stock like Tesla, I wasn't early to that. I wasn't early to Amazon. I was, I just waited and bought in. And those are 2 of my best performing stocks in my entire portfolio. Tesla, I'm up way more than 100% on. Same with Amazon. Okay, I started buying Amazon when it was $900 a share. So look, you can wait on these heavily valued stocks. And even if you're wrong and they pull a Tesla and an Amazon and go skyrocket, it doesn't mean you can't make money. Most of the time they do exactly what TDOC Health did. They go up big time and then they come crashing down, okay? Especially when you're talking about a company that doesn't necessarily have one of these market dominating positions, okay? I think they have a great brand. I think they have a great product, but there's lots of competition in this space as well. So we're looking for this company. It looks like they want to get to about $4 billion by 2024. That's just a couple of years away. I'll let you do the math on that price to earnings, but now we're getting really close to like 4 times sales if they can grow to $4 billion in just 2 years. So the valuation gets better and better. I know that we've looked at Teladoc in the past on our earnings videos, and it just got worse and worse and worse because the valuation was just way too high on this one. I think we're getting close to where you can start making sense of this valuation. And look, if you've watched my other videos in the past, I've been very critical of this company, okay, from their performance based on their valuation. Now their performance is starting to line up with that valuation. That's my first tip for you. If you're a new investor, you're wondering about price, you're wondering about valuation. Well, the valuation made no sense on this one. And I know everybody in the comments is saying, well, the valuation on Tesla doesn't make any sense. The valuation on Amazon doesn't make any sense. Well, those are just 2 stocks, okay? The vast majority of the time, that does not happen, okay? Tesla and Amazon are like, okay, they're like miracles. They don't happen very often. And I don't like having a miracle have to pull off for my investment to work. So I'd much rather have a bigger margin of safety. And obviously at today's prices, you're getting a way bigger margin of safety on Teladoc Health, considering the valuation has been chopped like lightning, okay? Now, the revenues, $521 million in the most recent quarter. That is up 80% year over year. I love 80% year over year growth, and I'm paying 6 times sales or 5 times forward sales at 2 years out. Okay, this is looking way, way better from a valuation perspective, okay? And then when we look at these numbers, the reason why we haven't liked this stock in the past is number one, the numbers just didn't match up with the valuation, okay? You got your revenue up here, $520 million. You got amazing growth, 80% growth year over year on that quarterly basis. And look, for the 9 months, you're doubling your revenue, okay? Up to $1.5 billion worth of revenue for 9 months. That is all good. But look, when you came down here to total expenses, you had $582 million worth of expenses on $521 million worth of revenue. I say this all the time on videos. If your kids had a lemonade stand and they brought in $521, but they spent $582 to bring that traffic in, you'd have to sit your kids down and explain to them the fine art of making a profit one day, okay? And look, I know Teladoc Health is still scaling up. It's different than a lemonade stand, but look at for the 9 months, okay? Doesn't paint any better story, okay? $1.5 billion worth of revenue, $1.7 billion worth of cost. Now, I know some of you are going to hop in there and say, hey, they did a big merger. They did a big acquisition. They do a lot of stock-based compensation. I get it. But look what the market thought about that excuse, okay? You guys have been making the same excuse on my videos for a year on Teladoc Health, saying, hey, they did an acquisition. Hey, a lot of those costs are stock-based compensation. Look what the market thinks about your excuse. At some point, tip number 2 for any investor out there, stop making up excuses the market doesn't care about. The market does not care about stock-based compensation. The market clearly does not care that they did an acquisition and that chewed up a lot of cost, okay? And they're waiting for cost synergies. The market doesn't care when you go from 307 like in February. I mean, we're not talking like 2 years ago. We're talking in February, we were at 307 and now we're at 107, okay? The market doesn't care. What they care about are profits. This company is not anywhere close to that. I wouldn't say not necessarily anywhere close to that. I think we're still another 12 months, probably 24 months until we can start looking at our loss from operations. I'm sure stock-based compensation, the synergies of the merger will start to work. And look, if you would have waited, look at the price you're getting this stock at compared to when this stock was at its high over the last 52 weeks. Patience, patience, patience plays off 99% of the time in the stock market. And I just told you, if it doesn't pay off, if being patient on a Tesla, on an Amazon, on pick any of your high flying stocks doesn't pay off, doesn't mean you can't get in later and make some money. Okay, now from a technical perspective, we are at a level that I kind of like, down here at about $100 a share. But look, we've been at multiple levels along here with Teladoc where we kind of liked 129, we kind of liked 120, and then we've just cut through it. So when a stock is making this big of a down move, okay, you have to, and I'm telling you, you have to wait for a sign of a reversal. And in this case, I think you need to be patient on this one. You need to wait until this one gets back into the 120. Look, there was a lot of investors that thought the valuation in Teladoc Health was completely irrational back in May of 2020 when it was at 172. Well, the stock went all the way up to 300, and these same people are like, this stock is crazy. It's way overvalued. Well, look, the market didn't care. And now on the way down, we have the same irrational thinking. There's many of you that are very bullish on Teladoc, and you're like, this doesn't make sense. It doesn't make sense. It didn't make sense on the way up, and it's not going to make sense on the way down. In fact, stocks tend, in my opinion, overcorrect on the way down because this was a pure momentum play, and the story and everything has completely broken down on this one. That is why I would wait for a solid reversal. Okay, you looked, here was the first sign of reversal. Okay, I'm going to zoom in on this the best I possibly can. And so this was back in May. The stock came down here. It made a low at 131, and then man, it looked really good. It came all the way back, and in fact, it came up to where if you were trading this right into a target area at 170, that's where the stock had some resistance and support in the past. Well, yeah, you'd probably set a stop loss somewhere trailing up into here, and the stock has completely gotten rejected. We had another layer of support here. Stock traded up, but now it's come all the way back down. In the basically shorter to intermediate term, this stock is still like making lower lows. Okay, so we have a low here, a lower low, and we're in the process of making another low. That's why I would still be kind of hands off on this stock, but I'd be watching it very closely. Okay, we are in this big down channel right here. This is where this stock is at. And until it proves that it's not in this downdraft, well, I still would not step in and buy this one. Unless we're talking about you've got a tiny portfolio or you've got a big portfolio and you want to grab 5 shares of this. Look, sure, okay. If even if you had a smaller portfolio, I'd wait. Okay, I think the smaller your portfolio is, the more concentrated you'd be on a $100 stock. I'd be even more patient. Okay, if we're talking fractional shares and you want to throw $5 at this, look, it's $5. Okay, but I would still want to maintain, even when we're working with small portfolios. One day your portfolio is going to be huge. One day you're going to have millions of dollars. Okay, I don't know why you're investing if that's not your goal. Okay, and so it's just like a basketball player. If you want to be a professional in the NBA, you wouldn't start shooting as a little kid with bad form and do all this crazy. You would want to practice the good stuff from right away. Okay, same thing here with this investment. I don't care where you are as an investor. This is an absolute falling knife. You're looking for areas of reversal. And so I'm looking for this one personally. It's got to get back up over 130. Okay. I wouldn't really get excited about this one and say, hey, we got to take out, at the very least, you got to take out the previous lows at 120. And then you will have made a low, a low, a lower low, but then you will have come up here and made a new high. Okay. That's what I'd be looking with Teladoc Health. Can this company snap back? I don't think so. I don't think you're going to necessarily miss the train here. Okay. And a lot of you are probably wondering, well, look, I got to wait till it gets up to 120, 130. Yeah, because look what's happened over the last 6 months with this stock. It's just absolutely fallen off a table. And if we break 100, which we broke 120, we broke 130, we broke 170. I mean, this stock is just breaking records all over the place. Because if we break 100, this stock's probably coming down to 70, okay? This is what happens when a stock just loses its momentum, okay? And we get down to 70, you shave this valuation off by another 30%. Hello, value stock. So I like this one. The lower it goes, the better valuation we get. I don't necessarily like it from a fundamental perspective still. We're still losing money over here. We've got excessive stock-based compensation on this one. These revenue growth rate, while it looks really good right now, it'll start to flatten out a little bit. That's why we have to get this stock at a very, very good valuation. And right now, from a technical perspective, this thing is in a downtrend. You are losing. The game is over. The clock is running out. This is not time to start trying to be a hero and try to win the game. You've lost the game on this one. So just wait, be patient, look for signs of reversals. A reversal in this big of a downdraft is a break well above, in my opinion, the previous lows, which are sitting right now at 120. If this stock comes all the way down to 70, which it could be in the next 2 weeks, this stock could get down to $70. Well, I personally wouldn't want to get back into it until we got above 100. okay? Because that's now your previous area of some support. It's acting as support for basically like 3 trading days over the last 2 years. That's not significant support. That's why I would not necessarily be super excited about getting into this one. But if it is an area where we're reversing, we should walk comfortably back up in here to 120, 130. That's where I'd like Teladoc Health. Now we're going to take a look at Palantir Technologies, ticker symbol PLTR. Stock is in a slightly different scenario than the other two that we're looking at. Palantir is actually flat on the year, down about 2%. We've still got a big valuation, and I'll show you what I mean by big valuation here in a second. When we compare this to the company's revenues, we got a $41 billion market cap on this one. Now, it has been higher. This stock has been as high as $45 per share over the last 52 weeks. It had a really nice pop. It seemed like maybe stimulus checks went out towards the end of last year or something. People just got super excited about everything in January and February of earlier this year. All these speculative kind of Cathie Wood stocks all kind of peaked then, and they've all downdrafted. But in the case of Palantir, the stock has actually held up quite nicely. Now, the CEO just appeared in an interview where he defended the company's stock-based compensation, which I'll show you here on cash flows and their earnings. And this is a direct quote. I tell you what, just anecdotally, this CEO looks super chill to me. And I don't know if I'd be that excited, okay? This guy looks really, really laid back with these sunglasses. I mean, he's got $1 million sunglasses on. I don't know if I want like most of the guys I invest in have like these $5 black hoodies, wear the same thing all the time. This dude looking like he just stepped off like a tennis court and just, ran a set. And then now he's going to go back, get a massage. Just kind of what I'm saying. We've heard the best and most interesting and eclectic people in the world. So this is what he's talking about his staff. He says they, referring to the employees, are fairly compensated, and we will continue to develop these products and continue to comp people. I think when we look at the numbers, their stock-based compensation has started to compress. Look, this guy's a smart guy. What I was saying was I'm basically joking. I like his style. I think he's a pretty cool guy. I think what he's doing is pretty awesome. Okay, now what I think he's doing here is doing lip service to the press behind the scenes with his shareholders, with his company. I think he's starting to do a little something different. This is why when you hear management and CEOs of companies speak, always take it like a politician. Politicians all say one thing. It doesn't matter who you vote for, okay? They all say one thing. Reality is always a little bit different. And I'm not saying these people are lazy. They don't get the job done. It's just saying one thing and actually getting it done when we're talking about politics and in companies, two different things. So this guy, I think, is saying to the media, look, we want to hire people. We want to hire the best. We're going to comp you good. Well, of course, if he said, oh, look, we're going to cut back people's pay, we're not going to pay these people, you think anybody would want to go work at Palantir? No. So he's got to get out here and kind of pump the company line. But when we come here and take a look, here's the last 9 months ended for Palantir. This is a cash flow statement. So they pull down a net income number, but in terms of net income, here's our stock-based compensation. Look at last year on a 9-month basis in 2020. They did over $1 billion. Whoa, over $1 billion worth of stock-based compensation. Notice that in the most recent quarter, it's now, the last 9 months, we're at $611 million. So we're declining by about 40% there. And so if we can do that again, I'm not necessarily anticipating they do that big of a drop, but if we can start to flatten this out and it can continue to steadily go down, well, this is a company that is on the right path in terms of flattening out their compensation based on their net income. I mean, this company had $364 million negative. Okay, they lost $364 million and they gave out $611 million worth of stock-based compensation. Incredibly rich compensation package. But again, it is down year over year. And so you'd expect that to continue. So the CEO is going to get out there and say, hey, we're going to hire the best and we're going to pay you the best. He has to say that. But when you look at the financials, it is starting to normalize a little bit. Now, what I did want to do when we look at Palantir, they've got revenue estimates heading out to 2022. We're looking at about $2 billion. We'll actually give them credit for that $2 billion. And I talked to you that this was a $40 billion company. So we're paying 20 times sales that are still like 2 years out. Okay. And so that's still incredibly rich. And I brought Microsoft up here. And I know I'm going to anticipate the argument back why I'm comparing Microsoft to Palantir. Here's Microsoft. Okay. A year out, June 2023, we're looking at $222 billion. No, not $2 billion worth of sales that you're getting from Palantir. We're talking about $222 billion worth of sales. We're only paying 11 times at the current valuation of Microsoft. You're only paying 11 times 2023 earnings. And I just showed you Palantir, you're trading over 20 times on just $2 billion. Now, I know the argument, you can't compare Microsoft to Palantir. Yes, you can, because the dollar bill I would put into my investment in Palantir is exactly the same one as I would put into Microsoft. My dollar bills don't care if it gets invested in Palantir. They don't care if they get invested in Microsoft. They just want to make money. Okay. And I'm not necessarily saying that you can't make money with Palantir. You just have to keep this in mind as an investor. You can pay 11 times sales on $222 billion worth of revenue, or you can pay 20 times sales on not even $2 billion worth of revenue a year out on either one of these companies. And again, investors make these decisions when they are looking at these companies. Now, in terms of the stock price, investors are trying to figure this one out. This stock has completely gone sideways from a consolidation perspective. We talked about how a lot of these Cathie Wood kind of high flyers really peaked back in February, and really most of them, or a lot of them, have just simply have not recovered from both a technical and a fundamental perspective. But Palantir is sitting at a level that it has bounced off many times over the last year, right about $21 per share. Now, when we went below it today, that was kind of a bearish sign, but it did recover. I wouldn't put a lot of stock. I am recording this the day before Thanksgiving. Wouldn't put a lot of stock what happens on Friday. A lot of people are going to take that day off. It's probably going to be thin trading. My guess is the sellers are probably on their yacht having fun. The serious buyers are having fun on their yacht. The stocks would probably melt up on Friday, all things being considered. It's really until next week when we really see what the follow through on this one is. We're looking for support here at 21. I tell you what, you get up to about $22, you got a short-term trade on this one, okay? Because you could buy it here at 22 saying, hey, we've maybe this is a bottoming formation right here. And we're going to walk back up into these ranges up here, 24, 25, 26. Now, the upside is all the way back up to $29. As you see, outside of the one kind of euphoria, eureka moment that we had with a lot of stocks back in February, this stock has constantly hit its head at 29. In fact, more specifically down here at 27. So if I bought it for 22 down here from a trade, maybe I'm doing options, maybe I'm doing something else with this stock, I would play it back up to this 27. And I wouldn't play it all the way to 27. I'd play it up to 25, hit a trailing stop somewhere in there, maybe even south of that, maybe 24, 24 and a half. Okay. So you're hoping this is a reversal pattern down here at 20. You're looking for higher highs. You're looking to get up here to 22, $23. There's a little gap here. I think you could fill that. If you get that high, you get up to 24, 25. This one would walk to 29. If it gets to 29, I'm expecting it to do the exact same thing it's done, get rejected and come down. Okay. Because you do have a fair amount of stock-based compensation in this one. The executives just kind of program Excel. This is how they get rich. This is how they, buy those mansions in Colorado or wherever this company is based. And this is how they live their life. Nobody is going to criticize them for doing that. Okay. They have to be compensated. They're more than welcome to sell their shares. Okay. But you as an investor have to keep that in mind because this stock has continued to walk back. Now, if the bear case scenario happens, so I think your bull case is back to 29. And then we start having a discussion, can it break over 29? Okay, but it's got to get there first. And we're talking $8 on this share price, probably more closer to 9. You probably want to get this up to $30 per share before you called that necessarily a breakout. That's your upside, okay, about $8. I tell you what, you break here at 21, you're coming potentially down and retesting these lows that we made back in May at about $17 per share. So your downside is pretty hefty as well. There's not a huge, massive risk reward on this one. If I bought in on a trade basis at this $21, $22 level, I'd have my stop loss set down here at about $20 per share. Because if you break this $20 per share level, all of a sudden you got a high probability of cutting another 30% off the stock price, getting down to about 17 on Palantir. And lastly, we're going to talk about Zoom Video. I just recorded a video on this company. I'll post it down below so we don't have to necessarily go through all the financials with this one. Now, this one has the biggest downdraft, over 51% over the last year, but we've still got a massive market cap on this one. Now, this isn't correct. I had to double check this because some of the numbers weren't adding up. We've got about a $61 billion market cap on this one. Right now, Seeking Alpha, I don't think is factoring in. My guess is this number gets updated maybe weekly, and this company just had a big, gigantic downdraft downdraft. When we look at the stock chart on Zoom video, we can see created a big gap from 240 all the way down to about $200 per share. That has shaved this market cap down to about $60 billion, give or take a billion or two. Now, in terms of the forward PE, these are correct. So we've got revenue estimates heading into January 2023. So we're looking at a little more than 12 months out on Zoom video. They're looking to do about $4.75 billion. The upcoming year, they're looking to do about $4 billion. That is about 13, we'll give it take a couple $100 million bucks, but we'll look at about 13 times sales forward on this one. Not crazy overvalued, okay? But what we want to do is factor in that the growth rate over at Zoom has started to stall. And here's what I mean by this, and this is a great look at it, okay? So we've got our revenue here. Take a look back in Q4. Obviously, this company was growing big time, okay? 188 million up to 328. That's gigantic growth. Take a look at this, over $300 million worth of growth. This is quarter over quarter growth, okay? You went from 328 to 660, okay? When you have this type of growth, look what happens to the stock. Speculation and yum on the street happens when you have that type of growth, because we're not talking, that would be phenomenal year over year growth. This is quarter over quarter. This company went from 328 up to 663. There was a reason why the stock went vertical, okay? People love this type of growth. And then look, it started to stall right here. Q2 into Q3 2021 went to about went from 663 to 777, and then it's still flattening out. Q4 of last year, 882, and then look at the really starting to flat. Went from 956 to 1.2 billion to 1.05 billion. We actually have gone completely sideways. Look at what also has gone completely sideways. This is our operating income from a GAAP basis. Take a look at this. Q4, it was at 256, went down to 226, back up to 294. That's good, but basically flat as well. So we're seeing everything flatten out. The revenue is basically a rounding error. Anytime you get to a rounding error flat quarter over quarter, that's not good, especially when we're talking about a $70 billion company, or in this case, about a $60 billion company after the most recent losses this week. And then our operating profits are starting to flatten out as well. But let's hand it to Zoom. They are profitable. They have plenty of cash on the balance sheet. This is a large addressable market. They have some, well-capitalized competitors, Cisco WebEx and among others, but this company does have a nice brand, and I've used the product. I think it does work to a certain degree. They have a lot of verticals they can get into, but look, we've just made a bunch of bull cases. Hey, Zoom video's good. Zoom's this, Zoom's that. Look at what the stock is doing. It is in this we're talking about a mega downtrend on this one. I don't know how you want to draw these lines on it. This looks like kind of a fake out to me. Gap below. Yeah, this kind of looks like what we're doing. Okay. And just like with TDOC Health, we are looking for a sign of a reversal. We're not trying to be a genius and not trying to say this is the bottom right here at 208, because I tell you what, I got lines down here at 160. This looks like the area of support down here. Now, 208 could be the bottom. I don't know. I would wait for it to prove it, because here's the thing. 280 looked like a good area of support. 240, when we recorded our video the other day, was the area of support. We talked about how, hey, I like 240 as a bouncing error, but I tell you what, if it doesn't, we're going way lower. And we had this line down here at 160 marked out saying, hey, if we break 240, that's kind of the next stop on the train. And so we are looking for a reversal. And if it happens in the shorter term, we're talking about probably here until the end of the year. So we're talking all the way through December of this year. You got to get above 240 on this one, because we talked about how 240 was support. Well, now it's going to be resistance. Our candle's going to hit its head on 240 and then want to bounce lower, okay? And then retest lower areas. So I would not step in this one. We're looking for reversal patterns, because this is just an ugly, ugly chart. And there's no reason to step in on this one, because there are other charts out there as well that just look way better. Okay. You can look at in an NVIDIA chart and just say, hey, this chart looks way better. Look at the stock. The stock is in an uptrend. This stock is looking good. It's gone parabolic, but it's consolidating at this areas. That's what it's done. Okay. For the last couple of years. Okay. So we like stocks that start uptrends. We don't like stocks that are locked in downtrends. I don't know why Cathie Wood continues to buy the dip on these stocks. I think it's she's playing with other people's money. She's looking 3, 4, 5 years down the road. Most investors don't have an unlimited bank account, don't have an unlimited amount of funds. And 4 or 5 years over your life could be a lot in terms of your overall portfolio length. Think about Cathie Wood. She's thinking about her fund 20, 30, 40 years down the road when she's not even there running it. Whereas you got to think about growing your money and then pulling it out so you can live, so you can send your kids to college, so you can pay off your house, so you can buy a new house, so you can buy a vacation home, so you can buy a new watch, so you can do what you want with your money. You don't have this like unlimited time frame. So we got to be patient. When these stocks are big downtrends, you got to be patient before you get in there and buy the dip. Even when you're seeing Cathie Wood doing it, even when you see certain cases where it might work, most of the time it just does this and you got to wait for a reversal. We're looking for higher highs. We're looking to get back into areas where we previously broke through and then keep that momentum going. You get above 240, really, quite frankly, you get above about 275, 280 on this one. That is where I would get excited on Zoom. You've got to make this move all the way back to 280. That is now telling me, whoa, buyers are here. The floor now looks like to be from 240 to 280. That's where the buyers really stepped in, and this is where the sellers dried up, because if we can get above that, well, now we've got all this green space. You don't have to be early on these stocks that have these big downdrafts, because you can go from 280 back to 4, and that's one of the best investments you've made probably in a decade. Same thing when we're looking at a TDOC Health. You can buy this one at 160. Just absolutely confirm that the downtrend is over. 160 to 170, probably even up as 170, could absolutely confirm this downtrend is over. We're in an uptrend. You can go from 170 back up to about 240 on this one. And that's a great investment. And then same thing with Palantir. You don't have to be a hero. You don't have to listen to these guys on YouTube that are constantly pumping this stock that does $2 billion worth of revenue. You got to get above 30 bucks on this one for it to really show you we're at a sideways consolidation. Guys, that's $9 on a $20 stock away from where we're at. That's a mile. Okay, this stock's way away from getting above 30. But you get above 30 on this one, I'd get excited about it. That's how I stand on these stocks. Let me know down in the comments below. Hopefully you guys have a great day. Good luck with your investments.